If you are not identifying the trend first, you are gambling. Every professional trader starts with one question. What is the higher time frame doing? Because direction creates probability. And probability is what separates trading from guessing. If the higher time frame is bullish, your job on the entry time frame is not to fight it. Your job is to align with it. Section 1. Directional Discipline. Now, ask yourself something simple. Why trade against the trend? To catch a few counter-trend moves? Yes, sometimes they win. But what happens to your win rate over 50 trades? Over 100 trades? 1 or 2 successful reversals do not define consistency. Sample size does. Counter-trend trading reduces your statistical edge. You are positioning against higher time frame order flow, against established structure. That naturally increases drawdown. And when drawdown increases, psychological pressure follows. You stop executing cleanly. You start reacting instead of following the plan. And slowly, logic gets replaced by emotion. Now compare that to a disciplined model. If the higher time frame is trending, the entry time frame is for alignment. And instead of forcing both directions on one pair, trade only with the trend and distribute your focus across 3 major pairs. You are not limiting opportunity. You are increasing quality. And here is something most traders misunderstand. When you stop trading both directions on one pair, it does not mean you will take fewer trades. In many cases, you may actually take more trades. Because instead of forcing setups in both directions on a single pair, you are watching 3 major pairs, waiting for clean alignment with a higher time frame. That means more structured opportunities, more qualified setups, and better timing. So, it is not about trading less. It is about trading with clarity. You know your bias. You know what you are waiting for. And when it appears, you execute without hesitation. Over a large sample size, that leads to a higher win rate, smaller drawdowns, and far less psychological pressure. That is what directional discipline actually gives you. Section 2. Determining the higher time frame trend. Before this section makes full sense, make sure you have watched the previous 2 videos, one about pullbacks and one about hidden change of character and break of structure. And know that for identifying the trend, we do not use hidden change of character or hidden break of structure, because our trend identification process is more mechanical and rule-based. Now let's move on to the main question. How do we actually determine the trend? The trend must be identified on the 15-minute and the 4-hour time frames. If price is forming lower highs and lower lows, the market is bearish. If price is forming higher highs and higher lows, the market is bullish. Price continues its trend by creating consecutive breaks of structure. And a valid break of structure is confirmed by a candle close. That part is simple. The complexity begins when we try to define exactly where the trend changes. Let's break that down. In many cases, price will break the last structural point only with a wick. That is where traders get confused. As explained in the lesson about the difference between change of character and liquidity sweep, not every break is equal. If the break happens with a long wick, the probability that it was simply liquidity collection is much higher. If the break happens with a small wick or with a decisive candle close, the probability of an actual structural shift increases. Now, an important clarification. On the entry time frame, every structural break is treated as change of character. We do not differentiate between long or short wicks there. What we are discussing now applies specifically to defining trend on the 15-minute and 4-hour time frames, based on backtested structural behavior. So here is the rule. If the break occurs with a long wick only, we do not consider it a valid structural break. That is liquidity sweep. Change of character is valid when the break forms with a close beyond structure or a small wick. And once we see a pullback followed by a break of structure in the new direction, the new trend is confirmed. Now, let's address the exceptions. What if change of character forms with a small wick, but the next candle creates a large rejection and returns back into the previous range? In that case, the market did not truly shift. That movement functioned as liquidity collection. Only when price breaks structure with a confirmed close afterward do we accept that the trend has changed. Another scenario. If the initial break forms with a long wick, we classify it as sweep. But if one of the following candles closes beyond structure, that is no longer a sweep. That is change of character. And at that point, the trend has shifted. Trend identification is not about reacting to the first break you see. It is about confirming structural intent. Now the question is this. We identified the trend on the 15-minute time frame and the 4-hour time frame. But how do we determine the final trend? And what is the relationship between the two? For example, if the 15-minute is bearish and the 4-hour is bullish, which direction should we follow? That question deserves a full breakdown. In fact, it is complex enough to be its own video, and we have already covered it in detail on the channel. Section 3, Full Multi-Timeframe Example. Let's walk through a complete scenario step by step. Assume today is February 16th. We plan to trade between 9 and 12. Our objective is simple. Determine today's trend. We always start with the 4-hour time frame. On the 4-hour chart, price previously formed a change of character with a candle close to the upside. That shifted the structure bullish. After that shift, price pulled back and then closed above the previous high, creating a break of structure. From there, price continued printing consecutive bullish breaks of structure, and the uptrend extended. Then, the shift happened. Price closed below the last significant low. That created a change of character to the downside. And after the pullback, price closed below that low again, forming a bearish break of structure. At that point, the downtrend was confirmed. From there, structure continued bearish. Now, this most recent low becomes our reference point. If price breaks above the most recent high, the trend shifts bullish. If not, the 4-hour remains bearish. So on February 16th, the 4-hour trend is bearish. Now we move to the 15-minute time frame. For the 15-minute, we start from the beginning of yesterday's full session cycle, Asia, London, and New York, meaning from the New York close onward. From that reset point, price was forming consecutive bullish breaks of structure. The 15-minute was clearly trending upward until price closed below the last significant low. That created a bearish shift. After the pullback, another close below structure formed a break of structure and confirmed the bearish move. Later, price reversed again. It closed above the most recent high, creating a change of character to the upside. After the pullback, a confirmed close above that high formed a new bullish break of structure that established a new bullish 15-minute trend. And that bullish structure continued into 9 o'clock. So for February 16th, between 9 and 12, the 4-hour is bearish. The 15-minute is bullish. That is a multi-time frame conflict. Now, let's look at another scenario. Assume we want to trade January 15th between 9 and 12. Again, we begin with the 4-hour. On the 4-hour chart, price had been forming consecutive bullish breaks of structure. Then price closed below the last significant low. That created a bearish structural shift. From that point, the 4-hour trend became bearish. Now, we move to the 15-minute. We begin from the start of yesterday's full session cycle. From that point, price was bullish until it closed below a strong structural low. That confirmed a bearish shift. After the pullback, a new close below structure created a break of structure. The bearish trend was confirmed. That bearish structure continued into 9 o'clock. Price never broke the most recent high. No change of character occurred. So for January 15th between 9 and 12, the 4-hour is bearish. The 15-minute is also bearish. That is full alignment. If this framework helped you understand trend structure more clearly, like the video, subscribe to the channel, and turn on notifications so you don't miss the next lesson.